From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, March 13th, and this is a Friday the 13th after a Black Thursday in global equity markets, and including back here in the United States. You're listening to the HPS Macrocast. This is Tony Fratto. I'm coming to you from a so far coronavirus-free location in the woods of Western Pennsylvania, and John Fagan and Brendan Walsh from Markets Policy Partners are back in the studio in Washington, D.C. Guys, I hope you're coronavirus free, and but the market was not coronavirus free yesterday. It was definitely bitten by the bug. The steepest drop in the S&P 500 since that October day back in 1987, which was the all-time worst day for equity markets. This day goes into the books alongside a whole bunch of days from the Great Depression and from the global financial crisis. So pretty bad day all the way around in markets. A really bad week. It's amazing that we made it to Friday. This was a very, very long week of almost round the clock looking at not just U.S. markets but Asian markets, European markets, and looking for the response from government. And it looks like overnight we got some news that I think we've been calling for a while, where we wanted to see some bipartisan support here on a fiscal package with Secretary Mnuchin talking to Speaker Pelosi. So that's good news. But why don't we take a look at just what happened to markets right now, and what the Fed did yesterday, and where we are, just where we think the macro impact is, and where do we go from here? John and Brenda, what are you seeing today?
Yeah, thanks, Tony. As you say, fortunately today we've got some green arrows. The markets are attempting to rebound after yesterday's really precipitous plunge. And just to roll the tape back, the week, it's Monday seems like an eternity ago, but it really kicked off over the weekend when the news on coronavirus, the outbreak, kept getting worse. Questions were proliferating about the official response and the efficacy thereof. And then we got we'll talk a little bit more about this later in the show, but an oil price war started between Saudi and Russia, which threw gasoline on the fire. Pardon my.
Yeah. But I almost forgot about that.
I know it was that really kicked off the week in a desperately disorderly manner, and it really ramped up. Taking a step back and looking at the way markets have performed during this period of the last month, from the perspective of policymakers at the Treasury Department, the White House, and at the Fed, the distinction that they try to make is between orderly, even if highly adverse price action, but orderly price action. We always use the shorthand of 2001. Boy, a lot of air was let out of that bubble. It was terrible for investors, terrible for their 401ks, but it didn't shake the foundations of the global financial system or really gum up the plumbing of global finance in the way that 2008 did. And that's really the distinction. Is this adverse price action that's orderly, or is this beginning to implicate more structural and systemic risks? And this was the week that the systemic risks and those strains really began to show. And certainly with an oil price crash, oil prices are down 30+%. It really in one fell swoop at the open on Monday, pressuring, and that reverberated through a lot of systemically important markets in the U.S. High yield credit is highly exposed to energy debt and to energy companies. And just seeing that deflationary impulse go through in some of these places really lit the fuse on what we saw play out through the rest of the week, which was increasingly intense risk aversion, self-perpetuating market selling. And that began to spill over into the kinds of strains that we saw in 2008, those liquidity strains, the issues in the interbank market, gappy, disorderly price action, even in treasury markets. We were getting indications of that. And we saw, in yesterday, the scariest thing yesterday was, market participants were really waiting for a fiscal response, knowing that fiscal is really where it's at in this.
Right.
Monetary can only do so much. It really is meant to try to address some of the liquidity strains that we saw, and central banks had to wade into this mess without sufficient fiscal cover yesterday. And
could you help? Hey, Jock, could you help some people just understand just what the Fed was doing there? I mean, there's just reading through Twitter this morning and seeing outrageous, misinformation and misunderstanding. Especially, for some people think that the Fed dumped money, just gave money to people on Wall Street to do, to buy stocks or something. They have no idea what, and it's not just, sort of rank and file people. This is coming from Bernie Sanders and others who don't seem to understand exactly what the Fed did. Can you explain the problem they were trying to cure in markets?
Right. Yes. They were addressing strains in the short-term funding markets. This isn't free money. This is how companies and banks engage in the business of funding both, basically their own business activities, but also the asset purchases and the market moves that they're making. When you have these short-term funding markets, they call them repo markets. When they have these strain and it begins, liquidity dries up in them and the funding costs go up. That basically has a knock-on effect into other markets. If you're having trouble funding in the repo market, some of you're funding purchases of treasuries and other things in the repo market. You're funding your business activities through these short-term funding markets. And so this is really about this is the Fed taking a big can of Drano and emptying it into these increasingly clogged pipes. And that is supposed to let the rest of the plumbing of the global financial markets run more smoothly. This isn't
when we're talking about liquidity. I mean, just for people if you're not steeped in this, we're talking about liquidity. We're talking about largely cash.
Cash. That is it. Yep. Cash demand, and
and so you're holding treasuries, but you need cash for one reason or another. But now everybody's holding their treasuries, right? And everybody wants to be in cash. So there's a shortage of cash available for people who want it and need it. So I show up with my highly, safe, treasury securities and expecting that I can exchange it for cash for some really short period of time.
Yeah. And you're not a normal person. You're the treasurer of Microsoft who's just trying to fund day-to-day operations. This is real America.
Payroll,
yes, exactly.
Right? Yeah, you want to pay your people.
This isn't Wall Street traders. Wall Street doesn't make much money off of this. This is functioning.
Yeah. So the Fed is saying, let us hold those securities.
Yep.
Here's the cash.
Yep. And then whether it's overnight or whether it's 3 weeks, you just trade them back.
Right. And so it's not free money. It's not the Fed buying stocks. It is the only question that market participants came out with was part of the announcement was that the ongoing asset purchase program, which is $60 billion a month, the Fed also announced that they would be buying different maturities. One of the reasons why the Fed officials, as we've said on this show before, why they've said that this isn't stimulative, this program of asset purchases isn't stimulative, is because it's concentrated in very low, basically 3-month T-bills. And so going out, the maturity curve for asset purchases gets you closer to quantitative easing. Now, quantitative easing is a stimulus program. The Fed has not hit that button yet. The expectation is that they're trying to get to their regularly scheduled March 18th meeting next week. The futures markets are pricing in at least 75 basis points of rate cuts, which would bring them really close to zero lower bound. But the expectation is that they are also going to engage quantitative easing, which is large-scale asset purchases of longer duration treasuries, but they could buy other potentially other assets as well. And that's what we saw the European Central Bank up yesterday. Christine Lagarde, at their regularly scheduled meeting, did not cut interest rates, interestingly enough, but she did increase the asset purchase program, and they instituted another concessionary small business lending facility that they put together. These were, these targeted measures, and these are targeted measures. Christine Lagarde was she was very sober about this. She did not she didn't take a victory lap when she introduced these things. She was still very much focused on the fact that governments have to come in. And, as monetary policy makers this week have tried to keep, four wheels out of the ditch and trying to keep, global liquidity working, they're really waiting for the fiscal cavalry to come riding in.
Monetary policy can only help maintain semi-order in financial markets. The reason we are is because of a virus, and the market is worried that we haven't had an adequate federal response from it, whether it be just getting the thing out of control or having a fiscal response to it. So actually today, go ahead, Tony.
I was going to say, really, up till yesterday, late yesterday, it looked like we weren't going to get that
at all.
At all. Yeah. I mean, it was really looking dire, and I think it was a big reason for the the historic sell-off yesterday, right? I mean, just this sort of lack of confidence that people are going to do anything. That they didn't get any confidence from President Trump's address to the nation the previous night, which was lacking in specifics and even had a number of errors, and threw another shock into the system with the announcement that the announcement that we're going to shut down all traffic between the United States and Europe, and then that had to be quickly amended to mean just foreign people who spent any time in the Schengen area will not be allowed to come to the United States. So there was incoherence. There's no question that we're late. We've been late on the health policy response. Although that is picking up now, and we've been late on the economic response, and that is picking up now too. I mean, we were just watching before starting today, Secretary Mnuchin talk about his discussions with Speaker Pelosi. Even the fact that they're talking about a package, I think, has inspired confidence in people that that the actors are going to get things together. And I've sort of my categories for what need to be done in a crisis like this are that of what not just investors, also investors, but people really want to see are bipartisan cooperation.
Yep.
They want to see global cooperation. They want to see the leaders working together, not pointing fingers at each other, and they want to see some kind of big response that is. It's got to be outsized. It can't be narrow and targeted, and it's got to come fast. Now, we haven't got the fast part yet, but maybe by next week we're talking about it, and we'll see whether they get big enough that gives people the view. Because I do agree with it. I do agree that this isn't like the financial crisis. We've said this many times, but with the financial crisis, you really could not see that there was an exit at the other end of the tunnel, right? It wasn't that you could see that the light at the end of the tunnel. You didn't know for sure whether there was that there was a hole at the end of the tunnel. Here, I don't think there's any question we're going to get through this period. It's going to be really challenging the next 6 weeks to 8 weeks. No question about it. It's going to be a deep hit. We've come to a sudden stop, but we are going to get through it, and we are going to get back to good economic activity. But we want to minimize the damage during that period. And the longer you wait, the harder it is to actually do that.
And we have a playbook from South Korea. Basically, you shut down the country for 2 to 3 weeks, you get it under control, and you have to pay people to not go to work. There's 330 million people in America. If you give everybody $1,000 a week, after 3 weeks, that's about $1 trillion. Those are the kind of packages you need. And actually, Germany today just announced the federal government's going to guarantee every SME loan made by a German bank. We need those kind of liquidity provisions here because, well, yesterday I was in New York and I went to get a haircut at the place I used to go. They were very worried because, just no one's showing up because no one's working anymore. But when everyone comes back to work, everyone's still going to go back to get their haircut. But these guys need a lifeline to make, to pay for their families to live, also to pay for their rent. Those are the kind of economic measures that we need from the federal government. And we need a health response. And we're actually doing it on our own. DC schools just got canceled for the next month. So the country is self-quarantined themselves even without the federal. They were doing it at the state and local level.
When you have a precipitous decline like yesterday, 9.5% down in the S&P 500, right to a trend. All the traders watch trend lines and that sort of thing. You tend to get a bounce the next day, but we can see some fundamental reasons for a bounce. It's not just what they call the dead cat bounce. When you look at some of the important things that have happened, as Brendan mentioned, Germany's loosening of the purse strings when Bundesbank, the German central bank, Governor Weidmann came out and said that this is not the time to be doctrinaire about zero deficits, what they call the black zero in Germany. That is, truer words. It's a little late to come around to it, but at least they're coming around to it. And now they're talking about putting billions on the table, the loosening of the restrictions on other European fiscal. Obviously, we saw Italy was going to do it anyway. So Italy took better to ask forgiveness than permission. And they've announced so Italy's package, they've upped it this week to $28 billion. The UK unveiled a $39 billion spending package, which included an infrastructure components. Australia has a 10 to 13 billion package. Japan's got 15.6. The U.S. did their we did an 8 billion to start with, but we've got to get our proportions, our proportionate response aligned with the rest of the world here. And so there's going to be a lot of attention on what is announced later today. And you mentioned that bipartisan aspect, obviously very important. We didn't get it necessarily as quickly as we wanted to, but the fact that it is, that balancing of sort of speed, size, and targeting, it has to be in some ways smart. You want it to reach the people that are going to be hurt the most. But I think one of the key aspects of what they announced today is if they're not going to do a line of credit where they allocate a bunch of money that could be deployed in the future if this lasts for more than a couple of weeks and spills over into, if we're talking more of a couple of months, if they need to highlight the fact that this may not be the last spending bill that they do, that this is, they have the capacity to do more, the will to do more, because this is not going to include bailouts for restaurants. It's not going to for the hospitality industry, for airlines. It's not going to have that this week. Yep. And that's probably going to be necessary. Yeah.
Because like John, in 87, we had a bounce, up the next day, then we went back down. And kind of going back to my point, I don't think we're going to find a bottom here in the markets until the market believes that the federal response is strong enough. One thing that very much worries me is the president seems to kind of be willing to die on the hill of the payroll tax, where everyone else in D.C. doesn't seem to want to do it. What's your thoughts on that, Tony?
Yeah, I've been a little bit lonely in this, in that there are a lot of people who don't like the payroll tax cut, and I'm not a huge fan of the payroll tax cut. It's not that I'm a huge fan of the payroll tax cut. It's just that I don't want to spend 5 days arguing against the payroll tax cut when we could be passing something to get something done. And if it means we need to throw in a payroll tax cut, whatever, throw it in. As long as you put a dial on it, and if you say, people are trying to estimate out the budget hit of a payroll tax cut from now until the end of the year. Well, it doesn't have to be
right. Exactly.
The year. It could be for a month. 2 months. Yeah. We could come back in 2 months from now and say, "Wow, that was pretty bad, but things are heading in the right direction. People are back to work. Jobs are back. Economic activity is back, and so we're going to be winding down the payroll tax cut." That makes sense to me. And but what I'm worried about is this view that we have to have the perfect plan. John, I thought your point about the Mnuchin and Pelosi saying, we treating this like a phase one, like we're going to do this right now, and then we're going to come back and see what else is needed and do more. I agree. That is the right. That's the right message. And what we want is, from these guys is a Mario Draghi, whatever it takes statement, right? We're going to do whatever it takes to stop this. But the thing about when Draghi said whatever it takes was he was able to actually do something right away. He could take action right away and say whatever it takes. These guys are saying whatever it takes, and we're going to keep talking, right? So like just go do it. And so I don't want to see fighting over the payroll tax, whatever. Like throw a payroll tax in, do all of these things. It doesn't have to be either or. We should do targeted and we should do broad.
Yeah.
And then, just have dials on it.
We did a call with clients earlier, and John made that same point. He said the payroll tax not the most efficient way to, not necessarily the best way to do it, but if you come up with this huge spending plan, it falls on people's shoulders like you guys when you're at Treasury to actually get the money to people. And that can be hard. A payroll tax is a very simple way to do it quickly.
Yeah. Yeah. And by the way, don't forget there are politics here too. And I don't mean just the politics of making sure that the White House is on board. I mean, one of the things that brought down efforts to deal with housing 10 years ago was, people complaining of, well, I did things the right way and what's in it for me? They're sort of like, well, I didn't get anything. Everyone else is getting something and I'm not getting anything. You do the payroll tax cut, you can say, look, we're helping everybody. Everybody's getting help. And so, everyone feels like, maybe some people are getting more and some people are getting less and they're hurt more than me. And, we're going to come together on this. But, you get a little bit of politics in here that there's something for everyone. And at the end of the day, it's yes, it's expensive, just not in the grand scheme of things. I think it's more damaging to not be providing support as quickly as possible. So, hey, let's come back and talk a little bit more about this. I'm going to get a little bit more into we just touched on oil, but I want to talk a little bit more about the oil price war and what exactly is going on there, because I don't think people have been able to pay enough attention to it. So we'll be back after this. You're listening to the HPS Macrocast.
Last fall, HPS introduced our listeners to Heartland Forward, a new think and do tank focused on advancing economic performance in the center of the country. It is now our pleasure to announce that Heartland Forward has released its newest research report, Millennials Find New Hope in the Heartland. The report, authored by nationally recognized demographer and Heartland Forward senior fellow Joel Kotkin, finds that the Heartland is attracting and retaining millennials at higher rates than in the past, with 3 of the nation's 10 best performing metro areas for millennials now located in the Heartland. Lower costs of living, increased high-tech job growth, and a greater sense of community are among the factors driving these trends. Read more, check out the full rankings, and download the report online by visiting heartlandforward.org and following Heartland Forward on Twitter at HeartlandFWD.
All right, we're back on the Macrocast. Hey, John, here's the deal. Like, you know how with CPI numbers, we're always stripping out food and energy. I don't follow energy all that closely. Like I know it's there, and like I see, I'm familiar with the consequences of high oil prices and low oil prices. But to me, they're always going up and down. There's always some, and they end up correcting themselves. And so I just try to I treat it as a sort of an inconstant constant. So I was as surprised as anyone last week with what happened with OPEC and this fight between Russia and the Saudis, and I guess we're in there too. Tell us what happened and what exactly is going on here, and how's it going to resolve itself?
So last week's OPEC summit was at the end of the week. It was in the context of declining oil prices, lots of concern about demand. And supply, the market being oversupplied pretty chronically. That's been a situation for a while now, and we've had OPEC basically progressively deeper and deeper OPEC, and OPEC, what they call OPEC plus, which is basically OPEC plus a few non-OPEC members, the key one being Russia. So we had the meeting last week. The initial recommendations from the technical committee were for an additional 1 million barrels per day output cut to support. This is not to, hoist oil prices to the moon by any stretch of the imagination. This is just an effort to put a floor under oil prices. And so there was nobody really expecting that this would lift them up way above. Brent crude was trading in the low 50s. That's kind of, that's pretty sweet spot, and easy for not too high, not too low, easy for markets to digest, relatively easy for producers to
everyone can pay their bills
profitable
there.
on. And so Saudi and OPEC, as much as President Trump and a lot of us complain about the cartel, they were trying to kind of do everybody a favor. Well, Russia declined to cooperate with the output cut. Russia and non-OPEC were asked to put up 500,000 barrels per day in additional cuts to support the million that OPEC was going to cut. And when Russia said thanks but no thanks and walked away, that was where we'd left it on Friday. And it was over the weekend that the Saudis decided to initiate an oil price war. And so the Saudis announced that they would, instead of cutting output, they would be ramping up to 10 million barrels per day, which was considerably higher than their current rate. And then there were reports that Saudi Aramco, the national oil company, was offering significant discounts to buyers, undercutting Russia. Everybody in oil markets knew exactly what this meant, which is this is a price war. And so the Russians weren't playing nice, but then the Saudis really upped the ante. And when everybody was bracing for it, when markets opened up on Sunday night, oil prices crashed. There's no other way to say it. They were down 30%. It was an absolutely it was a bloody day in oil markets. We had huge losses. And that spilled over into a lot of other markets. We'll talk about that. But the acrimony continued. Saudi said 10 million barrels per day. We're going to go 12 million barrels per day to a record. Russia countered that they would also be lifting their production to a record, and oil prices have been absolutely beaten to the ground. Brent is now trading in the low 30s. It was in the low 50s beforehand. And looking at this from a U.S. perspective, Saudi, these are our allies, and I don't know, friends. Do friends let friends start a oil price war during a pandemic? Isn't there a better time for this? I'm not sure.
The timing could not have been where it did have that feel of, and I think added to the great fear this week was just this, perfect storm environment that we saw going on between the sudden stop in the economy and then oil prices catering. It really was pretty frightening. We still don't know what the consequences of that are. Hey, why didn't Russia want to go along with supporting the price? What's their thinking?
Yeah, it's not necessarily clear. And when you have this situation, it's Putin is a geopolitical judo master and uses the opponent's aggression against them. The idea was basically Russia can free ride off of OPEC production cuts when OPEC is under the gun in a situation like this, when it's pretty clear that global demand is really plummeting. The one who really shoulders all of the cuts tends to be Saudi, and so Russia saw that their backs were against the wall, and as they usually do, they made some relatively aggressive, or they very often do, made some very aggressive moves, and Saudi responded in a way that is maximum disruptive. And we saw as one of my old colleagues at Treasury used to say, when a market that big moves that fast, it breaks things. And so when oil prices plunged 30%, it was a real accelerant, as I said, gasoline on the fire.
Yes, because it gets broken.
Yeah, it hits it hits, obviously oil producers and energy is a large sector of the S&P 500. And there were some absolutely incredible downside in some of these for some of these oil majors that we saw on Monday. But also, as I mentioned, the high yield market has a lot of energy credit exposure. Even the investment grade market does as well. And that is much more systemic than just equity prices. You can see that in the credit spreads blowing out. It's obviously very deflationary. It's a really bad time. Leveraged loans. Yeah. It's a really bad time to do this.
Henry Kissinger.
Go ahead, Brendan.
A couple of years ago, I read Kissinger describe modern Russia, and he was saying that when you have a society so in Russia, everybody doesn't believe that their kid's life will be better than theirs. It's a dying society. So to keep the order, you basically have to replace optimism with nationalism. So Putin doesn't. He needs to keep doing things like this to kind of mess with the rest of the world, and then put it on the state media saying, look at what we did to Saudi Arabia. Look at what we're doing to the shale patch guys. When Crimea comes up, you take it. You just have to be kind of a pest and then sell that to your citizens as strong Russia.
That's how Russia stays relevant on the global stage, and to a great degree, not the only degree, but that really is it. One of the things when we talk about oil, we talked about this when I was at Treasury. Obviously, we experienced relatively recently a very dramatic oil price crash in late 2015, 2016. And the things that we were talking about there, we were obviously watching very closely how high yield markets absorbed that punch. And how that interacted with the ETF market, where so many investors get their liquidity in high yield bonds, which are not a typically very liquid instrument, but they get equity-like liquidity through the high yield bond ETFs, and how that potential liquidity disconnect might create some fractures in the markets. In 2015, 2016, the resilience held out. There wasn't really any. There was obviously the industry is used to consolidation and periods of bankruptcy and times of difficulty and that sort of thing. One of the things we talk about it in 2008. What was so rough about mortgage-backed securities and some of these things was you couldn't value them. It was really opaque, and that highly synthesized and processed cheese kind of aspect. Where
and you didn't know who held them.
You had a mortgage-backed security backed by slivers of 1,300 mortgages and that sort of thing. In the oil, at least for oil, we know that a barrel of oil is not going to zero.
Yep.
Yeah,
that's gonna.
And we know exactly
value.
who made the loans, whether it's a small regional bank in Texas, or whether it's the high yield market, which is dispersed throughout the entire investment world.
And the loans are backed by real assets. Those are oil field assets that have value. And
the drills don't disintegrate if you file bankruptcy.
So it's not great, but at least there are some.
One thing we do
aspects.
Yeah, I mean, one other thing we do know with oil though is that you can get prices this low, and they can stay this low for a while, just but not for very long, right? I mean, because what happens is, it's assuming demand is constant or demand comes back, but you stop, especially with shale. Like shale's very flexible, right? You just stop producing for a while, right? And you could turn that back on later. If you want, it's a lot more flexible than I think it used to be, where you had big production that was hard to shut down, so you're coming into a falling price environment. With U.S. shale, it seems like there's a lot more flexibility to take it off and put it back on.
And the other thing is, the Russian energy minister suggested that OPEC might meet again as early as April, and we've seen these tiffs between OPEC members, between OPEC and Russia, and that sort of thing. There's certainly a possibility that whether the U.S. sort of impresses it upon our allies in Saudi, whether maybe another time is a better time to do it, or the Russians decide, well, we've proved our point, and they can change the dynamic relatively swiftly.
Yeah. Darren, come back and look at some data and look at the week ahead. Hopefully it will not be as crazy as this past week, but you're listening to the Macrocast. We'll be right back.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The HPS Civic Science Economic Sentiment Index accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through hamiltonplacestrategies.com.
And we're back with the Macrocast. Hey guys, one of the bits of interesting good news is, what happens sometimes is you get kind of automatic stabilizers. So we talked about, the oil price drop, and it's true. Low gas prices at a time of, we could use some economic support. Low gas price isn't all that bad. Support consumers a little bit. The other thing we saw, people talked about Fed. What are Fed rate cuts really going to do to solve a problem with the virus? And but one of the things we kind of saw earlier this week was refinancing way up earlier this week, mortgage applications way up. So that's something. That was some good positive data that we saw that could provide some economic support. What else is out there?
It's a really important point about the mortgage. And actually, it's interesting that the mortgage rates are falling much less so than the Treasury market because demand is so huge. The banks can be a little more competitive on that front. But next week we also get some more housing data with existing home sales. But certainly the housing market has been a very strong part of these low rates. We actually over the week got the NFIB small business optimism, which is
they're still optimistic.
It's above 100, which is it's quite doing well. We'll see maybe as we get forward. And we actually just got the Michigan consumer sentiment, which came in above expectations also. So while people are going to have to be home now, we'll see how much that cracks it. But the consumer has kind of held in there thus far. Next week, we get retail sales for February, which normally is a really important data point. It's probably going to be a little less so. Though we've talked about it a lot. I think the most important data point for the U.S. economy going forward is the weekly unemployment claims. That's where you're going to start to see the stress in the overall economy.
And we haven't seen that yet. It's been
hanging in.
Yeah. I feel like we've been
hospitality layoffs are starting. They don't have a choice.
We're getting anecdotal information. We're seeing announcements on it, and I think that's certainly going to come.
Yeah.
So,
but like we said, that's not an economic data point. That's actually a check that gets written by the federal government to people that are unemployed. So that's something we can follow on a weekly basis and trust that this is a real one. It's not just a.
It's not guessing. We're modeling.
Yeah. But next week we have a Fed Reserve meeting on Wednesday. We talked about what's already priced in. I'm not sure that we make it to that Wednesday. We might have to just do it now.
Well, I'll tell you what just came across as we were talking here is that in addition to all of the other sports events that have been suspended, postponed, in the case of March Madness canceled, we just saw the Masters is being postponed as well. So
they just announced it. Oh wow!
They literally just announced it while we're talking. So. Look, this is going to be, we can feel positive about, what I think we're going to see with government reaction to this. And I think we can feel good about the fact that there is going to be a, light at the end of the tunnel. But no one should be under any delusions that this isn't going to be a dark tunnel for a little while here. It's going to be, a real sudden stop. And for, as we sign off here, think about those people who are in those kinds of jobs that that require, that rely on tips and rely on traffic of people coming in. Pay those people, give them a tip, and when you see them, go. If we don't want people to do things that are unhealthy, but if you happen to be at a restaurant, give a little extra tip. The other suggestion I saw from someone on Twitter, which I thought was a terrific suggestion, is that you and I, we can go work from home in these situations. There are a lot of people who can't. The most important people who can't are the frontline first responders in the health sector. Now we're seeing schools close and their kids are at home. If you could help out a neighbor who you know who's a nurse or a doctor and help to watch their kids or do anything to support in that way, find those opportunities. Anything to help people get us through this very difficult period is, I think, what we would all like to see. All right, we'll be back next week. Everyone have a good and safe weekend. You're listening to the HPS Macrocast, and we'll be back next week.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.